Welcome to a special edition of the On the Tape podcast. Guy Adami, I'm always joined by the festive Danny Moses, and we're calling this Mailbag questions. Is that what we're calling it, Danny?
Yep, Mailbag from the mailroom, all that stuff. I keep saying short this market. I'll be in the mailroom.
No. Negative, Ghost Rider. By the way, last week we saw the volatility index, Danny, I think spike all the way up to maybe 25 or so. I know it got around 23. So that VIX, which was sort of circling the toilet, as they say, around 13.5, 14, had a pretty precipitous move. We'll see what that means, if anything, for the rest of this year and next year. But let's get right to the questions. We have some really good ones. I'm not going to dox anybody, as Amanda told me, and give out emails, because that's not what we do here at Risk Reversal. But if I recognize your name, I'm going to call you out by name. And the first one is from Jay Sloan, who's with us every day, Danny. And his question is, please reconcile the Fed's, in quotes, "we are restrictive and thus continuing to cut," with stock market at highs, and he used the term fart coins. I don't know what that means, with a $750 million market cap.
Yeah, well, that fart coins while you were away. And by the way, happy belated birthday to you, Guy.
Thank you.
I wish Brad Pitt a happy birthday as well, but he didn't respond to me, so I appreciate you acknowledging
there
that.
You go.
So Farcoin actually was at 1.2 billion last week. It's back down to 600 million. Not even worth discussing, but it just adds to kind of the idea of kind of where we are in the froth in this market. And so to Jay's question, I think that the Fed willfully ignores loose market conditions and really is focused on, quote, what is their neutral rate, and trying to get that right. He knows good and well how loose financial conditions have been. As a matter of fact, I think he's able to actually use that kind of as a quiver, because he has the ability to say, all right, and be a little hawkish, knowing the financial conditions are still loose, and kind of has his back. So I actually think he very well aware of it, Powell. And I think it's actually helped him with this kind of soft landing narrative, Guy.
Yeah, it's fascinating. And listen, as you know, Danny, and hopefully our listeners and viewers know this as well, I am no fan of the Federal Reserve. I am not a fan of central banks. I've been on record as saying, not that I'm anybody important, but I think amongst the many villains of the 21st century, I think central bankers are going to be on top of the list for a myriad of different reasons. And by the way, I think the wealth gap in this country was probably as large as it's ever been. In large part is due to Fed policy. It's going to be tough to prove that. I get it. But I think people are hurting for a myriad of different reasons. And one of them is because the Fed was so easy for so long, that helped people with risk assets. And on the way out, the inflation that they were begging for hurts the people on the middle and lower end of the spectrum. And as rates go higher, they're, I think, more inordinately hurt than other people. And, this will continue for the foreseeable future. With that said, I give Jerome Powell some credit for the way that he has navigated. I think he's made mistakes along the way. But to answer the question, how restrictive are things with, again, an unemployment rate still not at record lows, but within, a earshot of record lows, with the stock market effectively at all-time highs? Risk assets in the form of high yield indices and those types of things seem to be in check. So restrictive is, I guess, in the eyes of the beholder. I'm of the belief that, the Fed doesn't need to move at all. As a matter of fact, I can make a pretty cogent argument that the next move should, in fact, be a hike at some point. Now, the bond market is clearly telling a bit of a story here. As we're sitting here, we're looking at 10-year yields, again, north of 4.5%, which I know you addressed last week, whether it was on Market Call or on the tape. And I think that's going to prove to be problematic at some point. But restrictive, I'm not sure that I believe it, and I'm not sure that they believe it either, Danny.
People have to remember the Fed controls the short end, not the longer end. Obviously, what the Fed does and portends inflation will have an impact on the longer end here. But certainly, Guy, you're right. I mean, when we hit 4.5, the brakes came on the market, the VIX shot up, and all that stuff was going on. And I will tell you that from a public policy perspective, I think he made the right move, just to wait and see with the incoming administration. Don't worry about January, kind of take that off the table. And you know what? He can always cut 50 in March if he wants to. I think he was right to pause and sound a little hawkish alarm.
Yeah, well, we're going to see how this plays out. And again, the bond market is telling a story, which leads us to the next question. Equities are near all-time highs, which is true. I just mentioned that. And bond yields on the middle and the long end of the curve have been on the rise, which we also just addressed. The balance of risk and reward seems to favor putting new money to work in longer-dated treasury bonds via the TLT rather than equities, given that over the next 12 months, a decline of 100 basis points provides for better return than what most strategists have projected for the S&P. And the question is, does that seem reasonable? I'll take a shot at this, Danny, and say the following. I think I'm one of the few people, you may be in this camp as well, that think the TLT is going to surprise people to the downside, not the upside. I've said for quite some time, and I looked really foolish for a long period of time, that the TLT at some point was going to go and revisit the levels that we last saw in October of 2023. And that takes the TLT down to about 83, which back of the envelope suggests, maybe we approach 4.75%, 4.8%. By the way, I think there's a chance that we go a lot lower than that at some point. And the reason that I believe that is because of all the issuances that are coming due early next year, and for the debt problem that we clearly continue to have and nobody seems to want to address. And this incoming administration, I think, is going to be inflationary. All those reasons to me means TLT goes lower. I could see a scenario, Danny, where not only does the TLT go lower in a meaningful way, but equities do as well. And then it's just a question of picking your poison, because as you mentioned, although the Fed controls the front end, that's about all they control. And I think they're learning it the hard way right now vis-a-vis the bond market.
Yeah, so we got a little glimpse of that last week when the 60-40 trade went against both the 60 and the 40, which happened a couple of years ago, if you remember, at the beginning of the year. And so when equities don't work and bonds don't work, where do you go? The answer is probably cash. And I think Buffett has been ahead of that. So really, to me, again, it goes back to what is the factor that's going to send yields higher? If it's term premium that we talk about, or the risk inherent on you owning U.S. government assets, that's a whole different ball of wax than it would be if it's just going up because inflation expectations are moving higher. The point you make about our debt and funding our debt, both on the corporate side and on the public side, aren't going away. And there's a wall of maturities that are all going to reset higher. And so if you were to tell me that 10-year yields are going to be 5.5, you better tell me GDP is running north of 4% to kind of catch up with that, because we have to inflate our way out of this thing. So I would say, if you told me that, I would not want to own equities either. I do think we are potentially setting up for a re-inversion of the yield curve again. I think the next one would portend a recession if it were to actually happen, where we're higher for longer. But to the point that this question came in, do you go hide in, quote, quality, again, ignoring kind of the needs of the federal government to issue more debt in the term premium? And then you have a situation where the 10-year yields could drop back below 4%, but the 2-year starts to move substantially higher as the Fed is kind of trapped. And we're looking at potentially a little bit of a stagflationary environment, Guy. And at that point, I think you would want to own the long end. That'd be the only situation. But the pain threshold is high. The pain that would ensue is very high to get from A to B in that regard. And so it's easy to say you're going to do something and then actually do it. But it will be, I think, I'm hopeful that it's a flight to quality trade and not a term premium scare trade to the upside.
Yeah, well, we're going to see, Danny. It's interesting. If the yield curve were to invert again, it's going to be hard for me to figure out how that's going to happen. You just sort of talked me through it a little bit, but I don't know what that's going to mean. And, quite frankly, I don't think that's going to be particularly bullish for equities. And it would probably come in the form of, I guess, 2-year yields maybe getting up to 4.5 or 4.75. And for whatever reason, 10-year yields sort of stalling out where they are. And I don't know what triggers that. That's going to be pretty interesting to see. There's another scenario where we continue to sort of, I guess the yield curve continues to sort of normalize in a meaningful way, with 10-year yields continuing to go higher and that 2-year yield being pegged at whatever the peg level is. Let's maybe just call it 4.25, 4.3%. And under those circumstances, I can see the yield curve steepening to anywhere from between 0.75% and 1%. And maybe that will be perceived as bullish. But again, I don't think it will be, because I think yields are going to be going higher for the wrong reasons. But, so much is predicated, I think, especially in 2025, as to what happens with interest rates. And, in 2024, this year, you could have gotten interest rates right and gotten the market wrong. And, 2023 was a little bit different than that. But I think 2025, we're going to learn a lot about what the market thinks about our bond market and where yields should be.
The one thing I would add to that is the tool shed. Let's not forget what the Fed has, right? So we've gone from this kind of QE to QT, pulling back QT a little bit. There's nothing to say that we can't stop QT entirely and go back to a QE. There's nothing to say that the banks, that they won't loosen the regulatory requirements to own treasuries, right? So they can mess around with policy, that they control the short end, but they can mess around with policy and tools to. So you could be in a situation, Guy, I guess what I would say would it probably be more technical than fundamental for that to happen. Obviously, an inversion again were to happen here, but just keep that in mind that let's not forget, when there's pain comes into the markets, there's tools that are still out there. And yes, we extended the debt ceiling, now to March, but let's not kid ourselves. We're probably going to push it out again. And so if people aren't concerned about that, then you have a lot of room to play with here.
I'm going to take a shot at this question, unless you want to sort of take a run at it as well. This is a question about Intel. Any idea where the bottom is? It's been as low as basically $20, basically trading anywhere between $21 and $22. In terms of a bottom, I mean, if you've tried to sort of call a bottom in this name for the last couple of years, you've been unsuccessful probably 90% of the time. We've seen bounces along the way. But if you think about it, I mean, Intel was probably a $70 stock in the spring of 2021. And here we are at $20. By the way, as you know, Danny, during a period of which the market's done extraordinarily well, and obviously semiconductors is the place to be, yet Intel can't get out of its own way. And, if we were to get sort of through this 19 level, we're going to look at levels we probably last saw, I don't know, during the financial crisis, 08, 09, in the mid to high teens, which would be a staggering thing. Now, this is an $86 billion company. I think a couple of reasons to be bullish for Intel. Obviously, a change of leadership, I think, is really important. Not to cast aspersions, but they were clearly headed in the wrong way. And I do think there's a chance that somebody takes a flyer on them. Remember, there was talk about Qualcomm earlier this year potentially being interested. I think in this new administration might be more, I don't know, mergers and acquisition friendly. You could see somebody taking a run at Intel. And I've also liked it incorrectly, I need to point out, as sort of a homeland security play as things get sort of more, as countries get more dogmatic and dug in. So, look, it's been difficult to try to call a bottom in this name. It's traded horribly for, as I mentioned, a long, long time under a great broader market and in an industry that's done extraordinarily well. But this could be one in 2025 that the stock surprises some people to the upside. I don't know if you have any thoughts there. If you don't, we will move on.
Yeah, I'll just add quickly. I think there's going to be a honeymoon period where the transition to new leadership will get the benefit of the doubt. Everyone's now expecting bad numbers to come in. I agree with you. I think you might hear some M&A noise and chatter there, and you just can't have this type of valuation dispersion between, I get it, the sexy AI companies and the non-sexy AI companies. But let's be clear, within the next few years, with the right leadership, all these AI, quote, chip companies will then start to converge, I think, with the old school kind of tech semi companies that you're going to see, at least from a valuation perspective, a movement towards the middle here. And so I actually like it from a risk reward perspective.
This is something that you talk about every year that we've been together. And this is a question: what's each of your picks for the dogs of 2024 that will be turnaround names in 2025? And he or she points out that names for them are UNH, Pfizer, Uber, TAN, the TAN ETF, I should say, HCA, names like that. So take a run at that, Danny.
Listen, I'm going to go where you're probably going to follow here. You're going to have the same thoughts here, and that's energy. And when I look at ExxonMobil, Chevron, Occidental, and I said this a couple of weeks ago, yes, if we go through an economic cycle, I get it. There's no demand for oil. China, no demand for oil. But with all the M&A that has occurred and how efficient these companies are and how clean their balance sheets are and the return of capital, dividends, which is really how you would kind of describe the dogs of 24, it'd be the top yielding companies if you want to go dogs of the Dow. So I think owning those companies, and listen, Buffett has a lot of cash. We've talked about it. I'm not saying he's going to go buy Occidental Petroleum, but I would not be surprised to see him, take a much larger stake in the company. So I'm a buyer of at least those three stocks, if not the entire integrated universe there.
Yeah, it's amazing to me, and don't at me if I'm wrong, but if memory serves, I think Warren Buffett started to announce a stake in Occidental, I think in early 2022, like January or February of that year. And he probably started accumulating it before that. So he probably started buying stock, if I had to guess, in the high 30s or so. And that's just a guess. What's remarkable to me, Danny, and you're probably just as surprised as I am, over that period of time, I mean, there have been times where this stock, I think, got up to almost $74 or so in the fall of 2022, but it's been going sideways to lower. And as we're sitting here now, you have a stock that's trading around $47.50 or thereabout. And I saw the paper loss for Warren Buffett, was, I think, 20 billion or so dollars. Don't at me if I'm wrong. Not that that matters. And he added to his position last week. He clearly sees something here. I thought I saw what he saw. The market clearly isn't seeing any of it as we're sitting here right now at levels that we're approaching probably where he started getting in the first place. With that said, I agree with you on energy. I think people are underestimating the valuations here and just underestimating the earning power that these companies have. And they look at, to me, energy stocks, and they just look at where WTI is and they trade it on the back of that. You've said this a number of times, and I will reiterate, crude oil can go sideways here from between 65 and 75 for the foreseeable future. And these companies, most of them at least, especially the big cap integrated names, are extraordinarily profitable and at valuations to me that don't make any sense, but should make sense if you're looking for value plays. So it's energy for me. And I'll take a real quick stab at UNH, understanding the tremendous headline risk associated with this space, obviously highlighted by what happened a couple of weeks ago. You're at levels now in UNH, sort of this $500 level if you go back. I mean, this was support back in the summer. We've seen this as resistance. So this was sort of a prior high if you go back to sort of the fall of 2022. So prior resistance becomes support. As I mentioned, we've seen support here. You can make a very compelling case for UNH on valuation. I think as the news cycle changes in the new year, I think the market's going to catch on to the valuation around a UNH. We've seen sell-offs in this name before of this magnitude. And at a certain point, the market figures out that these are just cash flow and valuation machines. So UNH, I'd throw in that mix as well. This is right up your alley, by the way, Danny. I know you're bullish on gambling stocks. Last week, a couple of senators were throwing around the idea of regulating DraftKings and FanDuel in the United States. What would that look like regarding their operations, larger tax bill, et cetera?
So you're going to continue to hear noise about tax legislation. We saw it in the UK. They actually threatened to double the tax for the online gambling companies. It didn't pass, but it could certainly come up next year. State of Illinois obviously effectively doubled their tax rate, actually maybe even a little bit more this past year. The stocks took a hit and then they kind of recovered. I think right now the macro for these stocks are still so strong that it outweighs kind of that risk. And I think for now, they're kind of buy on the news or rumors of those tax hikes. And I don't expect that to go away anytime soon. So, I just think that right now the growth, and keep in mind also that these companies, when I talk about these companies, DraftKings and FanDuel really in particular, are morphing into media companies. I mean, they have channels now and there's advertising revenue. And yes, of course, the bulk of the business is still gambling. But think about this. When you see these rules and these tax laws, it's going to impact all the companies across the board. But from a liquidity perspective, the bigger companies are obviously going to control their own destiny. They have the economies of scale. And the bad news out there for the consumer guy is that for the players is if you tax these companies more, guess what they're going to do? They're going to offer worse odds for you. And guess what? You're still going to bet those parlays and those in-game live odds. So anyway, I'm still long and strong these companies. I buy on those type of news events.
Yeah, I agree with you. You've been right on these. I mean, you started pointing out these names long before anybody really started to talk about them in earnest. I mean, it's interesting. I mean, they've been times where they've looked like they're just going to be a parabolic stock, like some of these tech names, like a biotech name, and other times where it looks like regulation is just going to knock them all out of the box. But, I've been in your camp for a while, and I think these are ones you just have to have a little longer term view on and understand that you're going to have some headline risk along the way, but they're going to be winners in the space. And I think you've pointed out a lot of them. This is an interesting question from Alan. Do you think a barbell type approach of growth and dividend paying stocks could benefit in 2025? Or will the market continue to chase growth? And then they say, thank you for all you do. You all provide a steady balance in a market that makes no sense at times. Alan, I appreciate that. I'll take a shot at this. I think the chase for growth might continue early in 2025 until interest rates start to get in the way and until people realize that the valuations that these names that they're chasing are trading at. And there's a reason why, Danny, as you mentioned earlier, that Warren Buffett is now sitting with approximately $325 billion of cash or cash equivalents on his balance sheet. And that Buffett indicator at any given time is vacillated between sort of 202% and 210%. And that's on the back of a lot of these names that people are chasing into. I mean, passive investing, as you've pointed out, is fantastic on the way up. But what people don't realize is, everything gets dragged up in a world where money just flows in regardless. And at a certain point, valuations don't make any sense. So I'm not looking to chase growth in 2025. And it's going to be interesting. If you think rates are going higher like I do, maybe dividend stocks are not the place to be either. So what is that going to mean? You're going to have to sort of pick and choose in sectors that have been sort of left for dead. So hopefully that answers your question. I'm of the belief that the chase for growth is going to stop. Interest rates are going higher, which theoretically, in my opinion, should make dividend-paying stocks less attractive. That includes utilities, by the way. We'll see. Do you want to take a stab at that?
Yeah, I was just saying it's a little bit of an oxymoron, growth and dividend-paying stocks kind of together. You do have some of these dividend-paying stocks which actually are growing. And I would say those are probably the ones that you could own even in a higher rate environment, because let's be clear, I think dividend stocks in general have, other than they get indexed and they're owned by certain funds, haven't kept up, but because they're not, quote, sexy, because they're returning capital and they're not reinvesting it, which by nature, if you're paying out your money, that means you technically don't have anything better to do with it. Therefore, it's not a growth stock. So a lot of mixed signals going on in the market, but owning quality, I think I would call it, if that comes in the form of a company that pays a dividend, great. If you have a company that pays a dividend that's also growing, even better.
This is an interesting question. I own a stock and I'm looking for protection to the downside. Which is the better option, a stop or selling puts? Well, selling puts does not offer you any protection whatsoever. I mean, selling puts is basically adding to potential of a long position that's going awry. Remember, when you sell an option, you have the obligation to buy or sell at a strike price by virtue of the fact that you've taken in that premium. So I am not a big believer in selling puts, especially, Danny, I think you probably agree with this. When the VIX was down around 13 and a half, I don't think people were getting paid nearly the amount that they should be that's commensurate with the risk that they're taking. You can make an argument for that as volatility goes up, but I'm still not a believer in that selling puts, and it does not provide any protection to the downside. Obviously, a stop provides you protection if you're true to the stop, right? I mean, if you have a stop in, you have to stay true to it, and you have to trigger it when, in fact, that level is reached or your pain tolerance is reached. Obviously, one way to protect on the downside is to buy puts in an individual stock or to buy puts maybe in the overall index. But selling puts, Danny, as you know, provides it does not provide you any safety whatsoever.
I would assume that the listener miswrote when they said that, because obviously, yes, selling a put means you're going to own more at a lower price. To your point, you'd rather sell calls and or do some type of call replacement where you sell the stock, and if the volatility is low, you just buy calls, you can participate on the upside, or you buy puts, to your point, at a certain level. We won't go into put spreads and all this for this call, but listen, I think one of the problems people have right now is they're FOMOing. They own a stock, it's gone up double, triple, that's great, and they own the same amount of stock they did when it was down 50% lower or something like that. When you start to think like that, what I believe, just take some off the table. And you know what? If the stock continues to move higher, you're still there participating. If it moves lower, you get the opportunity to buy more. And it's a stock by stock basis, guys. So I don't want to give out any type of information without knowing the underlying volatility on a certain name, the qualities of it, but just be smart. And I think it comes down to money management.
Well, and this leads to a question from one of our listeners, viewers. Do you think growth stocks will be the leading stocks in 2025? I addressed that, but I'm curious as to what you think. You're probably sort of in my camp, I have to guess.
What's the definition of growth? Are they growing faster than they have historically? Are they growing faster than the economy? Are they doing things inside the company from cost cutting that's having a one-time impact on their earnings per share and they're growing? So again, I think finding the right sector from a macro perspective that has growth and picking the best companies within them is the best way to do it. But if you're talking about just kind of, let's just be clear, if we're going after the NVIDIAs of the world, and so, some of the names which have had big runs here, the answer, would I own those things into 25? I wouldn't own as much as I did before. I'd probably look to reallocate into some of these, quote, stocks that have been left behind. We mentioned Intel 20 minutes ago. Not the worst idea to sell some NVIDIA, stick it in, some Intel. So
that's fair. And this is an interesting question, and I appreciate this. What environment would it take for you guys to get bullish on the stock market? Would it require a nice pullback first? Thank you. I'll take a stab at this, Danny. And, everybody talks about it's different this time, and, historical valuations, they don't apply in the environment that we find ourselves in for, again, a lot of different reasons, none of which I agree with. So for me, it would take a meaningful pullback and to get valuations more in line with where they've historically been. So when you're talking about an S&P 500 right now that's trading probably close to 22 and a half, 23 times next year's earnings, I think more reasonable, especially if rates are going to continue to go higher, is somewhere between 17 and a half and 18, but 17 and a half being sort of the norm. So when you're a couple turns away from the historic averages, you can see a market that's expensive. I mentioned the Buffett indicator before. There are other kinds of things that are clearly flashing red as well. So for me, when I say a healthy pullback, I mean a pullback that gets valuations more in line with what normal is. And, again, people want to say it's different this time. I don't think there's anything different about it this time other than the enthusiasm around the stock market.
Yeah, and to your point, VIX sits at 12, 13, bang, 27. It's staircase up, it's elevator down. And most of the time it's been a buy the dip mindset, and it's worked. And so at some point, that's not going to work any longer. And so the problem, Guy, as you just described, becomes once these stocks do have a precipitous sell-off, what is the buy point? When you break this kind of 35 to 40 multiple on certain stocks, or 22, 23 in the overall S&P, is it 20? Is it 18? Is it 16 times? It really depends on what you think the outlier, what is the future growth of these companies and the markets in general. And you just brought out, there's so many macro factors that you have to consider, where rates are, geopolitical stuff that's kind of out there. And over the last 3 or 4 months, we've seen these 2 to 3% type days, 3 to 4% type weeks on the drawdown on the downside, some for geopolitics, some for the Fed that they think has misstep, some for potential policy things that are going to happen in 2025. And all those things, none of those things are going away. And so when I think of opportunities, like I've said all along, sometimes you get great opportunities to buy stocks on sell-offs that never participated in this upswing. And you got to make your list and just be diligent and be patient with this market.
This is right up your alley. This is from Adam. Can you speak to the pros and cons of leveraged ETFs? And then the next question is too risky. You are extraordinarily well equipped to answer this question.
Yeah. So actually, when I saw this question come in, I obviously did some cheating here on this. I wanted to get ahead of this because it's really important to me. So short term, if you want to express a view in something in a particular sector or a particular name, you can own one of these levered ETFs if you want, which whether you're expressing a short view or a long view. Over time, though, just understand that it's effectively 1% almost a month in some cases, some percent more. And I want to read this because I just found one of these and I want to explain. So let's just use this one called NAIL for it. NAIL. You'll love this one, Guy. So it's a 3X on the home builder index, and it's actually tracking the Dow Jones home builder. So it's a DJ, SHMBT. It's Horton, it's Lennar, it's NVR. It's just like the XHB basically is what it's going to be. And so in the disclosure statement, right, I wanted to read this. It says, so the fund loading factor is basically 0.97%. It's like, okay, that's not too bad. Except what's been happening, Guy, is because of these 3X, people are, these managers of these levered ETFs have to go out on swap, or they have to go out into the options market to basically create the position. So if demand starts to come in and you have to buy, there's not enough stock out there, you go to the options market or you go to the dealers on Wall Street. Well, there's only so much leverage that you can take. So what happens is you start to see massive underperformance on big up moves and big down moves because of the cost basically to create and maintain these levered ETFs. And so we've seen stories about the MicroStrategy levered ETF, the single name ones, just be smart. Like, so if you can use call options in the marketplace, which by the way, the uptick in option activity is directly related to these levered ETFs, which I just mentioned as well. So the answer to your question is I would only use these things for a very short-term bet because the cost to carry these things is massive.
And I don't think people understand that. I mean, they're not, well, I don't know why they were created. Let me just say that. Obviously, I was not in the room. But in my opinion, they were not created as investment vehicles. They've been created as trading vehicles, as you just pointed out, to hold these things thinking, I don't know, that you're going to somehow catch something cold. I mean, you can go back and look at the deterioration in some of these levered ETFs. And basically, if you don't, again, catch these things cold, we call it bleeding away. I mean, there are other words for it as well. But the way these things dilute over periods of time is pretty extraordinary. So if you're looking for short-term trades, if you think you know something, I say more power to you, but understand, in my opinion, they're trading vehicles. We have a couple questions that are all very much the same from a few different people, and it basically go around best call of the year, worst call of the year, best trade of the year, worst trade of the year, those types of things. Fred actually said, we don't need to give us the worst call. We all know it was Tesla, which is fair. But you want to take a shot at that? Because I know mine.
Yeah, I'll give you the best and then I'll go to the worst. And so I think the best were Genius Sports and Flutter for different reasons, which owns FanDuel. Genius Sports was a left for dead SPAC. By the way, so was DraftKings for that matter, which I think gave it the opportunity. FanDuel, really interesting. They actually moved their listing to the New York Stock Exchange and no one really was paying attention. That's a massive technical boost. That happened at the beginning of the year as well. So Genius and FanDuel, I think, for the advent of sports gambling and also technicalities, and Flutter's a huge company here, were the best longs I had. On the short side, listen, and just to be clear, the day after the election, I was basically out of the rest of Tesla, whatever I had left, because I realized it wasn't going to be a fundamental trade from there, and it really wasn't a fundamental trade for most of the year. Shame on me for thinking that would be the case. But credit spreads having been so tight over the course of the year was shocking to me. And I guess in hindsight, you're raising money, in the private lending markets. It all needs to be used in various, whether you're making loans, all these private equity firms, they're doing loans to Upstart, they're making loans to Affirm, they're buying their loans off their books. And so the shorts were working on Affirm and Upstart, right, at various points of the year. And then all of a sudden, just money has to find a home. So credit spreads remain tighter. I was wrong on. I do think we're starting to see Carvana, Upstart, and Affirm. If you look at those stocks, it's nothing more than credit spreads widening a little bit over the last week and rates moving higher. So I will tell people these companies are not technology companies that I'm talking about. These are companies that are dependent on credit spreads being tight and the loan markets running well. So I actually believe that at some point these stocks back up. So that was a misstep for me, Guy, was underestimating the power.
Yeah, listen, we all listen. I mean, my wrong opinions are too large to mention, but I'll mention a few. Not being a believer in Apple for the majority of this year is clearly proven to be incorrect. And, I've tried to point out the absurdity in the valuations that it trades at, and the fact that when it was a growth stock 7, 8, 9 years ago, it was trading at a value stock valuation. And now that it's basically become a bit of a value stock, it's trading at a growth stock valuation. So something's amiss. But I think Apple wins to, as I said earlier in the show, just cash flows and passive investing, and the amount of ETFs that Apple's a top 1, 5, 15 holding in, they win in an environment where money just flows. So obviously that was wrong. Recently, I thought Qualcomm was going to make a new all-time high in the back of earnings. That was about a month and a half or 2 months ago. I looked like a genius for about 24 hours, and that stock has completely fallen out of bed. So even in a sector that's done well, you can have some missteps as well. In terms of a good call, I mean, IBM to me was an interesting call earlier this year. It was non-consensus. People were not looking at it. And I thought there was a real chance that IBM had finally figured things out, and they would sort of be a value play for people looking to get sort of this tangential or second derivative AI stuff. And to a certain extent, that's been playing out, maybe for different reasons, but it's been working regardless. So, IBM is one that I'd stand up. And then things that have sort of meandered, I've been right in energy, wrong in energy. I mean, that's been painful. But I still think, as you said earlier in the show, I think energy people are going to flock to early in 2025 as valuation, as the run towards valuation becomes more and more prevalent, just my opinion. Do analysts review GAAP financials as a measure of a company's financial health, or non-GAAP measures and non-financial data the norm today?
That's the phrase, these aren't the droids you're looking for. So, you always got to be very, very careful. So let's be clear. GAAP financial, generally accepted accounting principles, are only thing that the auditor signs off on. Everything else, you can kind of create your own KPIs. You can adjust out this. It's things you need to be wary of. And there's actually good reasons sometimes when they're useful. They're useful to use non-GAAP when you make a big acquisition. You want to apply a valuation to goodwill. There's one-time restructuring costs, and they want to give you a real feel for what's going on at the company, excluding that. So we hear about EBITDA. We hear about, getting rid of depreciation, amortization, get rid of interest. What does the underlying business look like? But the one that bothers me the most, Guy, in this non-GAAP world is stock comp. When you adjust out for stock comp because it's stock-based compensation, what are you not paying the person? So this person is getting paid. They're getting paid a portion in cash and a portion in stock. You're excluding that out. Why? That is an expense of the company. So things like that I watch for. So be very wary when companies try to point you to a certain metric when there's something else going on in the core business. And there's reasons for that. And it's not illegal, But just be honest, because at some point, the non-GAAP thing catches up with you. And so again, nothing illegal about it. A large percentage of S&P companies do report GAAP and non-GAAP. But what you'll see on these, and then I'm going to lose everybody here, you have to reconcile your GAAP and non-GAAP. And people should, I'm sure they won't, read the Q's and K's if you want to really get nerdy on this stuff. But anyway, just be smart about it.
No, and you've said that for a while. I mean, we had Meredith Whitney on a couple of weeks ago. She talks about this as well. Nobody's, well, I shouldn't say nobody. There are very few people left that actually want to do the work necessary to understand what's going on, because in an environment where stocks just go up, why do you need to bother? And I think that's become sort of the methodology for I don't want to say for everybody, for a lot of people. And respectfully, that methodology has been okay, quite frankly, because when you try to punch holes in things over the last year and a half, I mean, you can make an extraordinarily cogent argument. You can make a cogent argument on what you just talked about, but until now, and we'll see what it means going forward, the market hasn't seemed to care. We'll see if it does in 2025. My sense is it may, especially with rates going higher like I think they will, and maybe more of a microscope on what is actually going on with some of these companies and earnings and valuations. We got a lot of questions around NVIDIA, at least 7 or 8 from various people. All the questions are basically the same. What's going on with NVIDIA? What do you think about NVIDIA? I will say this. Clearly, this is a stock that confused me for the lion's share of the last couple of years. I want to put that out there. However, there have been 2 times this year specifically where I think I've done a pretty good job. Once was in March, where the stock made a new all-time high, and we talked about it, and then had a reversal. We call it a gap island reversal or an engulfing pattern. And I talked about it in March, and I thought the stock could pull back anywhere from 30 to 40%. And having made an all-time high in the middle of March, you saw a stock that was down probably about 30% into the middle of April or so. That same formation happened again in June. And I will tell you, the stock probably traded up to 142 or so. And then by August 5th or so, you had a stock that had breached $100 on the downside. So you can do that math as well. We saw something similar the day after earnings a few weeks ago. It's actually longer than that now. And I do think we're setting up for a similar move. And, whether it's technical or fundamental, I think there's a chance that you see another 30 to 35% move to the downside off that prior high of 152 and change. And I'll just throw the valuation thing out there because I do think it's important. People will say on a price to earnings level, it's a reasonable stock. That is true. But it's also true because they're outkicking their coverage in terms of their revenue stream. And it's a company that's reasonable on a price to earnings metric, but it's expensive on a price to sales. And when those margins come down, and they invariably will, because we've seen this dozens of times before over the years, when competition comes in, you're just not going to enjoy the revenue. You're not going to enjoy the margins that you've enjoyed over the last few years, regardless of where your place is in line or how much of advantage you have. Once that competition comes in, margins deteriorate in a meaningful way. And that's when I think the price to sales ratio is going to come to a more reasonable level. Now, the optimist is going to say they're going to grow into those sales in terms of revenue. Maybe we'll see if that happens. The pessimist like me will say their best years in terms of that metric specifically, Danny, are behind them. I'm not a hater. I just think it's a company that's extraordinarily expensive in this environment. Quick thoughts if you have any.
Yeah, quick thoughts. It's a healthy pause here, or a little bit of a drop, I think. I mean, if you own the stock and you're a reasonable investor and you're rational, it got a little bit ahead of itself. I think where it sits now, it's a show me story in the sense of, show me that the next quarter is going to be as good. To your point, show me you can maintain mid 70% margins, effectively in a hardware company, which we know historically at some point gets commoditized. It's a really a balancing act between where does it start to slow down, and where does valuation meet? And at some point it's going to meet. And whether that meets, 30% up from here or 30% down from here, I don't know. But congrats to the people that have owned it here. Again, look at the size of your position, where you own it, the valuation. And I would be very concerned if there was any downtick in the growth assumptions in this guy, even a delay in getting some of these new platforms out and so forth. I don't think the benefit of the doubt will be with the longs. I think it'll be with the shorts.
Yeah, we're going to find out. And again, I think it's a really important year in terms of, again, what the market is willing to pay for this company. As with everything else, we're going to find out. we got at least 15 to 20 questions, Danny, about gold. So I won't read them all, but they're basically the same thing. What are your thoughts on gold in terms of the Fed, in terms of interest rates, in terms of what we're seeing in China, in terms of what's going on with dollar yen, which, by the way, I think is approaching 158 again very quietly. You've seen this deterioration in the yen yet again. So there are a lot of reasons out there, at least in my eyes, to continue to be bullish of gold, despite the fact that we've seen a bit of a pullback over the last week and a half.
Never in my career. And basically, I've been following gold pretty closely since 2008, 2009, that time period when the world looked like it was ending. You wanted to see what you could kind of hide in and really understand it. And I really wasn't fully bought in maybe until 2012 or 13, really understanding the dynamic of the market. At this moment, I've never, ever been more bullish on a risk-reward basis. When I say risk-reward, I don't see lots of downside here for gold. I think crypto has stolen its thunder a little bit. And, you see what happens with the advent of ETFs in Bitcoin that made it more accessible to buy. You can see how much it moved. I think we are nowhere near gold being in the mainstream in terms of retail investors. Everyday investors do not own it yet. I don't think central banks are going to be selling any gold. You've made this point over and over again. That's a hedge against their own ineptitude. I think that is the case. The geopolitics that are out there. So when the dollar strengthens like it does, and Investopedia tells you when the dollar strengthens, you should sell gold because it's a direct correlation. Fine, I get it. But those are the days you want to be buying it. And you're going to have days here, I believe, in the coming months where gold will be up $100 to $150 over a period of a week. And I think we're going to go through 3,000 in the course of 2025.
Look, I agree with that. And for all the reasons you cited, I understand as 10-year yields have gone higher, people have shied away from gold. Historically, that's been the correlation, which maybe makes sense. But, I'm going to contradict myself a little bit and say, it's different this time. I said before, it's never different. But in terms of gold, there are obviously other things going on. And the amount of gold that central banks have been buying over the last few years is staggering. Earlier this year, I think it was in April, we learned that the Chinese had stopped buying gold. And if you go back and look in the spring, you saw a pretty significant downdraft. But recently, Goldman Sachs just put out a note that actually that's not true. And the Chinese have been buying gold in the more opaque over-the-counter market, which I thought all along was probably what's been going on. So gold got back on its horse. Gold's going to have days where it falters on the back of a myriad of different things, potentially dollar strength, bond yield weakness or bond weakness, yields going higher, those types of things, maybe crypto taking a little of the thunder, as you also said. But in the environment that we find ourselves in, with the debt levels that we have, all roads continue to lead to gold. And I agree with you. You said over the course of a week, I'll even sort of fine tune that. I think over the course of a day or two, you're going to have these $150, $200 moves in gold that nobody sees coming. I don't know what the trigger is going to be, but it's clearly out there. So I'm going to stay with it on the gold front as well. This one's for you, Danny Moses. As we approach the end of the season in the league where they play for pay, who do you see playing in the Super Bowl this year?
Wow. I mean, Kansas City, it just finds a way, and they're getting healthier every week that goes on. And, there's a lot of stats out there. If you clinch your division or playoff spot or home field early, those teams will find their way to a Super Bowl. It looks like a Buffalo, KC potentially coming out of the AFC. I feel like the Ravens just have kind of too many holes there. And the NFC, if Hurts comes back and he's healthy, they never would have lost that game to Washington yesterday. I think Philly looks good the year that kind of Barkley is really having. And I don't know if anyone can challenge them. I do like the way that the Rams are playing. Obviously right now, I just don't think they have enough firepower to get through. And in the NFC North, obviously, somebody's going to come out of there. You look at Detroit, you look at Minnesota, look at Green Bay. Those are the other teams that can challenge here. So I really think it's the Eagles probably and Detroit. Although if Detroit has any more injuries, I don't know if they can get through it here. But give me Philadelphia probably versus either Buffalo or Kansas City in the Super Bowl is kind of what I'm looking at here.
Yeah, it's interesting. Obviously, as a Giant fan, it's hard for me to root for the Eagles, but until proven otherwise, I think they're the prohibitive favorite. But I'll say this, for whatever reason, you just mentioned them, but Minnesota is one of the teams that they're just not getting any credit whatsoever this year, and they seemingly win every week in different ways. And on a fast track, I think it's going to be really hard to beat that team. So, if all roads lead through Minnesota, potentially, It's going to be hard to beat them. We will see. I like the Lions. I'm rooting for the Lions. I'd love to see them come out of the NFC. And I get the Chiefs. I understand it, but it's been smoke and mirrors this year. It's seemingly every week with them. And good for them for winning these close games, but it's going to catch up to them at some point. And I agree with you with the Ravens. Lamar Jackson's a stud, but there's just something about that team where they seemingly figure out how to lose in the wrong spots. But I think this is a year where the Bills finally acquit themselves. And you say what you want, but Josh Allen is just a stud. So I'd love to see like a Bills-Lions, Bills-Vikings Super Bowl. I think that'd be a lot of fun. But we will see. And then the last question for you, Danny Moses, is how thankful are you to be hanging out with people like Amanda Diaz, Timmy, Jacob, Dan, even Bill Hockman on almost a daily basis?
It is amazing what you guys have built over there and the team you have and the products that you guys are putting out. I really mean that. And so really impressive. It's great to be around. And really, I think the most important thing is culture, and everybody, has one mission, and that's really to help the investors that are out there and help educate and entertain at the same time. And I think you guys do a great job of doing that. I'm happy to be a part of it.
Well, you're a big part of it. And I want to thank everybody for the questions. We got to as many as we could. Maybe we'll do these once a quarter, Amanda. We'll see. But we appreciate all the thoughtful questions. And again, we tried to address as many as we could in this period of time. Hopefully everybody had a great Christmas, great Hanukkah, Kwanzaa, New Year's coming up. We obviously thank you, and we're looking forward to some really cool things in 2025. So Danny Moses, on behalf of Dan Nathan, as I said, Amanda, Timmy, Jacob, Bill Hockman, thanks everybody, and we'll see you soon.